Good afternoon, everybody. My name is Amber Hines with WealthMerge. I want to thank you all for taking the time to join us today. Today, we're going to be talking about Medicaid planning for a single person that doesn't have a spouse and also has qualified or IRA accounts. I'm happy to have Mark Munson, who is a practicing elder law attorney in Wisconsin. He's also licensed in Illinois, Kansas, Missouri, and South Dakota. Mark is a certified elder law attorney, and I'm very excited to have him with us today. You can go ahead and type in any questions that you have into the GoToWebinar dashboard. We've also supplied a copy of the slides in the handout section, so feel free to download a copy of the slides if you wish to. And like I said, if you have any questions along the way, just feel free to type those in. Again, my name is Amber Hines. I'm with WealthMerge, and if you haven't worked with WealthMerge before, we are an insurance agency that specializes in Medicaid compliant annuities offered by A-rated insurance carriers. So all of the insurance carriers that we work with and that we're talking about today are going to be either an A or an A+ rated insurance carrier. So that's a big deal if we're worried about the financial stability of the insurance company that our clients would be investing money into. Okay, so we're going to start out with some basic information about Medicaid as far as the asset and the income eligibility requirements. In most states, if we have an individual client that is not married or the spouse is deceased, we are able to keep around $2,000 of assets in the person's name. So this is going to be a little bit different in some states like New York. An individual is able to keep around $15,000. In Missouri, the number is around $3,000, but generally the amount that somebody can keep is around $2,000. From an income standpoint, when we're talking about Medicaid eligibility, generally the client's total income must be less than their cost of care. There are some exceptions to this. If you're in an income cap state, then generally the income must be below $2,300 approximately without having to supply a Miller Trust or employ a Miller Trust or a qualified income trust to get the income below the cap amount. What can we do if you have a single Medicaid client that has excess assets? We can develop a Medicaid eligibility plan, which can include increasing or improving non-countable assets, such as making improvements to the client's home, purchasing a new car. If we need medical supplies for the client, we can buy those types of items. Also, purchase prepaid burial policies to spend down additional resources, pay off credit cards, mortgages, or other debt. And then finally, we can also purchase a Medicaid compliant annuity that complies with the Deficit Reduction Act of 2005.
Okay, so this next slide is color coded for a reason. The reason is that this is the federal statute, so it applies in all 50 states as to annuities, and you know, I think we're going to use the term Medicaid compliant annuities because we're talking about qualifying or making someone eligible for Medicaid, and annuities can be exceedingly helpful in this context. And so the reason for the color coding is because clients have various assets, and because they have various assets, various rules are going to apply. So when you see, and the reason we did this slide color coded is so that we can distinguish between what rules apply to what assets. And so what's in yellow, what's at the top, that applies to every single annuity. It doesn't matter what kind of annuity it is. What's in yellow is going to apply. So if you have a client that's going to be applying to Medicaid, you have to comply with what's in yellow. It doesn't matter. What you see in green, that is for what we call an IRA MCA, or an IRA Medicaid compliant annuity. So those are the rules that you need for a Medicaid compliant annuity that's within an IRA. Code section 408 is actually the Internal Revenue Code section for IRAs. 408A is for Roth IRAs. So below that in the red, that is the language that has to apply to non-IRA MCAs or non-IRA Medicaid compliant annuities. One word of note, one word of caution is that I would suggest that the irrevocability and non-assignable component that is in the non-IRA MCA also be built into your IRA MCA, so that you take away the argument of the IRA being an available resource or asset. But that's the reason for the color coding. This is the federal statute. Yellow applies to all IRAs. Green applies to yellow applies to all MCAs, Medicaid compliant annuities. The green applies to IRA MCAs, again, with the idea that it should also be irrevocable and non-assignable. The red is what applies to non-IRA MCAs. So a Medicaid compliant annuity, that's an annuity that's going to comply with the statute that was just referenced on the previous slide. And if you're going to be using non-IRA assets for a Medicaid compliant annuity, you want to make sure that all of the requirements listed on this slide are included in that annuity. That's what would make it a non-IRA Medicaid compliant annuity, and Amber knows those rules very well.
Okay, so if we're looking at purchasing a Medicaid compliant annuity with non-IRA assets like Mark just mentioned, we can use really any type of non-IRA assets that a client might have. If they have checking or savings account, certificates of deposit, brokerage accounts, stocks, bonds, life insurance, or non-qualified annuities, all of these types of accounts can be used to purchase a non-IRA MCA, and it would have to comply with all of the rules that we just referenced on the last slide. If we have clients that have brokerage accounts, stocks, and bonds, we would need to liquidate all of those to a cash position before we actually purchase the non-IRA Medicaid compliant annuity, because we can't do an in-kind transfer over to a Medicaid compliant annuity. It would need to be liquidated to cash first. And if we have clients that have life insurance or non-qualified annuities that were purchased several years ago that would have quite a bit of taxable gain, in order to liquidate those accounts, we can initiate a 1035 exchange of life insurance or non-qualified annuities to fund a non-IRA Medicaid compliant annuity. But really our focus today is going to be talking about how can we deal with retirement accounts such as IRAs and use those accounts to purchase a Medicaid compliant annuity.
All right. So when confronted with a client who needs to get on Medicaid, so a client in the nursing home, we want to focus on, what can we do, and what we, fortunately, the rules are much more liberal in terms of what we can do with an IRA MCA. So that's a retirement account. That's the IRA portion. MCA is Medicaid compliant annuity. So the IRA MCA, we can make it longer than life expectancy. That requirement is not part of the IRA MCA. The annuity contract doesn't need to be actuarially sound, and we can do a balloon payment. So we have much more flexibility with IRA MCAs as compared to non-IRA MCAs. And this is just a slide that kind of shows that. And, you'll notice at the bottom of the non-IRA MCA, you have to name the state as beneficiary. You have to do that on the IRA MCA. That's part of that language that was in yellow. But the only requirement that we see, other than naming the state as a beneficiary, is that you're going to likely want to have your IRA MCA be structured in a way so that it is both irrevocable and non-assignable, and that will help you with the availability argument. The value of that federal statute that we just referenced above is that if the rules are followed, whether it's for an IRA money or for non-IRA money, if the rules are followed, it prohibits the government from making a transfer penalty argument by taking action with respect to an IRA. So there is no penalty for merely making something unavailable. Normally, if you do that, you're going to get a penalty period, but here you can't because federal law prohibits it.
Okay, so Medicaid crisis planning is going to be pretty simple when we're dealing with post-tax accounts such as checking, savings, CDs. We say that is pretty simple because we're not worried about the income tax implications of liquidating or transferring accounts when they are not a pre-tax or IRA account. But planning becomes more difficult when we're trying to do crisis Medicaid planning and clients have the majority of their assets contained within an IRA or a pre-tax account because we can't change ownership of the account from parent to child or transfer those assets into a trust without causing a taxable event. So most of us are aware of the reverse half-a-loaf or gift and annuity strategy that's used in a lot of single Medicaid planning scenarios, but we're going to kind of look at today the implications of doing a gifting annuity plan versus other planning techniques if clients have large retirement accounts and what's going to be the best option for the clients.
And so, IRAs are known to most of us. We don't need to spend a lot of time on this slide. The rules for IRA MCAs are really going to apply to any type of retirement account, 401ks, 457 plans, tax sheltered annuities, thrift savings plans, the 403b. That being said, it's probably going to be easiest and best to have this money in an IRA as opposed to any other type of retirement account because of the flexibility offered with IRAs in terms of the investments.
So each state is going to be different as far as how IRAs or qualified accounts are treated for Medicaid planning purposes. States are going to take one of the three approaches that you're seeing on this slide. They're either going to completely exempt the IRA and consider it to be a non-countable asset altogether. There's a couple of states that do this. Other states are going to consider the IRA to be an exempt resource or an unavailable resource if the client is receiving their required minimum distribution or systematic payments from the account. Or the state is going to completely count the IRA as an available resource or an available asset. So it's going to be a countable asset. Most states are going to take the third approach. There's 40 states that consider the IRA account to be an available resource to the person that's in a facility.
And they really don't care if it's in payout mode, if the IRA is in a payout mode, if it's a IRA or a regular IRA annuity, even if it's annuitized, I don't think that they care too much. They're always going to count it as a resource, which is a problem in terms of getting your client qualified for Medicaid because they can only have $2,000.
Correct. So going back to what I just mentioned, planning is going to be the most complicated in states where the state considers the qualified account to be an available resource. And like I mentioned, 40 states across the country treat the qualified accounts of the person in the facility to be accountable. What are the Medicaid planning opportunities when we have a client that is trying to qualify for Medicaid and the retirement account is treated as accountable resource? We have 3 different options that we're going to go through today. The first is a gift and annuity plan, or some people refer to this as a reverse half-a-loaf plan. The second option would be to use an IRA Medicaid compliant annuity. And the third option is going to be a combination of the two. So our example here is dealing with Mary. She's a single individual who is 85 years of age, and after living at home with dementia for years, she is now in need of nursing home care. Mary's family feels that she could live for many years in this sort of supported care environment. Her total countable assets are $200,000. They're all after-tax dollars or cash checking or savings accounts. Mary has monthly income of $1,000 from Social Security retirement benefits. She's currently paying $8,000 per month for her nursing home, and the Medicaid rate is $6,000 at her facility. So some states are going to publish the Medicaid rates on your Medicaid planning or on the Medicaid department's website. So some states you can find that information pretty easily. Other states I found that you need to actually contact the facility and see if they will provide the Medicaid reimbursement rate to you. So that's a question that we've gotten in the past about how do you find out what the Medicaid reimbursement rate is. So throughout the webinar, we're going to be going through several different case scenarios, but they're all going to be based on Mary's private pay rate being $8,000 a month and the Medicaid rate being $6,000 per month. So that won't change regardless of the different scenarios going through cash examples versus IRA examples. So our first option would be to do a gift and annuity plan. So the goals in a gift and annuity plan is to allow a single Medicaid applicant to make an immediate wealth transfer or a gift to his or her intended beneficiaries. By making a gift or a transfer within the 5-year look-back period, the client would be incurring an ineligibility or a penalty period associated to making a gift. The calculations I'm not going to spend a ton of time on. Most people are pretty aware of how the gift and annuity numbers are determined, but we would be taking the monthly income shortfall, so the $8,000 a month that Mary is spending on her care, and subtract the $1,000 of monthly income that she has to determine that her shortfall each month is $7,000. I'm then going to add the monthly divestment penalty divisor in Mary's state of 8469 to get a total amount of $15,469. If I divide that number by the total spend down amount or total available resources that Mary has of 200,000, I would determine that Mary is going to be ineligible for Medicaid for around 13 months. I would create a gift or a transfer in this case of around 110,000 that could be transferred to Mary's children or to a trust in order to get that money out of her name. And then we would use the remaining $89,903 to purchase a 13-month annuity that would create monthly income of around $6,930 per month. And really, the annuity is designed to provide additional income during the 13-month ineligibility or penalty period that Mary would be serving as a result of gifting the 110,000 of assets. The economic results in this case, Mary is going to be ineligible for Medicaid for 13 months. This is going to be the private pay or the penalty period. During the penalty period of 13 months, she's going to have monthly income of $7,930 during the penalty period. So she is incurring a monthly income shortfall of $70 per month. That's going to be a requirement in order to get Mary to be considered otherwise eligible for Medicaid based on the fact that she's spent down to $2,000 or less and her income is less than what the cost of care is. She would become Medicaid eligible in month 14 after the penalty period has expired. The advantages in this case is that we were able to gift around 110,000 to Mary's children. And because we were dealing with after-tax dollars or money that was in Mary's checking or savings account, we're really not concerned about the income tax consequences of making the gift because we aren't dealing with any IRA dollars in this scenario. Mary does become eligible for Medicaid in month 14 after the penalty period has expired. The potential disadvantages of this type of plan would be that if Mary does not live for the full 14 months, she would not have received any economic benefit from Medicaid because she was really using her own assets to privately pay during that penalty period, and Medicaid doesn't start paying until the 14th month. So like in this case, in the other examples that we're going to be talking about, life expectancy is going to be a factor in whether we would recommend this type of plan or a different type of plan to get Mary immediately on Medicaid without incurring that penalty period. We're going to change up the scenario now and assume that Mary has some IRA accounts and some non-IRA money to use and go through the same scenario of doing a gifting annuity plan. So we'll assume that her total assets now that are non-IRA are 110,000 and she has 90,000 of IRA dollars. The private pay rate is still going to be 8,000 and the Medicaid private pay rate is going to remain at $6,000. The numbers work out to be exactly the same in this scenario, other than we would be using an IRA MCA to purchase the annuity that would pay for the 13-month period. So the income generated from the annuity is going to be exactly the same, but the advantage of using the IRA MCA in this example by either doing a trustee to trustee transfer or a 60-day rollover is that we're able to spread out the tax consequences of the IRA as it pays out over a 13-month period. So depending on when the payments fall, as far as what month the client would be seeking to start the penalty period, we can potentially spread out the tax consequences over 2 or 3 tax years when it comes to when the payments actually make payments. Instead of paying all of the tax consequences in one tax year by liquidating the IRA, we can do the trustee to trustee transfer or a 60-day rollover to spread out the tax consequences as the annuity would make payments over the 13-month period. The economic results of the fact change using the IRA dollars versus in gifting the cash assets really aren't going to change the math or the outcome all that much, other than the fact that we're going to use IRA dollars to purchase the annuity. And like I said, in order to purchase the annuity, we would likely be using a 60-day rollover. That is going to be a quicker option than to use a trustee to trustee transfer. but just know that that is an option if clients have some cash assets and some IRA assets that we're looking at spending down. It would be in their best interest to transfer the non-IRA assets and use the IRA assets to purchase the annuity during the penalty period.
So we're now going to deal with the scenario of the only real asset remaining. So mom is either, but Mary in this case is either spent down all of her non-IRA money, and all that she has left is just IRA money. What do we do with this? What do we do with this IRA money? So, clearly we want to consider the income tax issues. Amber has, in previous presentations, Amber refers to IRA assets as a ticking time bomb because of the income tax issues. I refer to them as a loaded gun because of the income tax issues. So we're going to have to be sensitive to the income tax issues with the IRA assets. And so because of that, we have to think about what's going to make the most amount of sense in terms of structuring a Medicaid plan if our client, in this case Mary, is in the nursing home incurring costs of $8,000 a month. So does it make sense in a case such as this to take money out of the IRA and to make a gift of that money to the kids? In this case, we're talking $110,000. So, so this is what we want to think about. If we take out $110,000, first of all, we know we're going to have to pay tax on that. So if you look in the gray bubble, we might only be netting $90,000 and having to pay tax on 20. Well, the paying the tax on the 20,000 is certainly not a gift. That's a debt that Mary's going to owe. So we want to factor that in as part of what we would be doing. That may be a spend down, and then what we have left over may mean that we could even take more out of the IRA. Granted, that would be more taxes, but this is all just math. But the question is do we want to pay that $20,000 in tax right away? So that's part of what we're looking at when you have these larger IRA assets. So option 2 is maybe what we want to do is just convert the IRA into an IRA MCA. There would be no tax consequences with doing that, and then we just have to look at the structure of the payout.
So the goal the goals in using IRA MCA as opposed to making a gift or a transfer is that we're able to obtain immediate Medicaid eligibility. There isn't a private pay period of time that the client is going to have to actually pay out of pocket. They would be obtaining immediate Medicaid eligibility. We're also going to defer the income taxation as long as possible by using an IRA MCA. And we're also going to create the greatest possible wealth transfer after the person passes away. And we're also able to take advantage of the lower Medicaid rate, in this example, $6,000 per month versus the client paying out of pocket at the higher rate of $8,000 per month. The payout on an IRA MCA could look something like what you're seeing on the screen here. So we can use Mary's qualified account valued at $200,000 and immediately eliminate the IRA as a countable asset for Medicaid planning purposes by purchasing a $200,000 IRA MCA. We would purchase this by having Mary be the owner of the IRA MCA. So this is going to be considered her monthly income, and we could fund the IRA MCA by using a 60-day IRA rollover. With Mary being 85 years of age, her Medicaid life expectancy, according to the Social Security tables, is around 7 years or 84 months. Like Mark talked about in the beginning of the webinar, we don't technically need to follow the Medicaid life expectancy. We could do a longer period of time, but we're just, for example purposes, we're using her actual life expectancy to show that if she invested the $200,000 within her Medicaid life expectancy of 84 months, the annuity would provide monthly income of around $2,400 per month. The total payout, as you can see, is going to be slightly greater than the $200,000. That's just the interest that would be paid on the annuity contract over the term. By converting the $200,000 into the annuity, we're able to immediately get Mary onto Medicaid. And in order to determine what her Medicaid copay or Mary's responsibility to the facility would be, we would be adding her existing Social Security income at $1,000 plus the annuity income that we just talked about at $2,400 to get her total income of $3,406 per month. We're then going to subtract the personal needs allowance, or the amount that each state would allow for Mary to keep as income to pay for haircuts or personal items that she would need. And we determined that her monthly copay or Mary's responsibility to the facility is going to be $3,356 per month. If we assume that Mary proceeds with the $200,000 IRA MCA structured over her Medicaid life expectancy, and she passes away 15 months into the plan, Mary's children would be listed as a remainder beneficiary after the state Medicaid department, and they would receive a wealth transfer, in this case, of $124,250. We came to that number by taking the initial amount that was put into the annuity at $200,000, and we subtracted out the Medicaid annuity payments that she would have received during the 15-month period. So that's around $36,000. And then also, with the state being the remainder beneficiary on the contract, the state would be entitled to around $39,000 for a total of $75,750.
So, well, go ahead, Amber.
Go ahead.
Well, I was just going to share, if Mary did not have help and assistance in terms of looking at her assets and doing anything in this case, she would have been spending down on her assets at the rate of $7,000 per month. And so if she did live 15 months, 15 months at the rate of $7,000 a month would be $105,000 spent on long-term care. And so that's what would have been spent on the care. If you look back of what was spent on care with doing the Medicaid compliant annuity with the IRA, it was around $75,000 of total payout. The annuity paid out, and we had to use the annuity payout to pay for care. And then when Mary died, there is going to be a payback component to the state. And if you added those two together, it was around $75,000. And so there is a definite wealth benefit of using the annuity in this case and going on Medicaid. And really all that is the difference between the private pay rate versus the Medicaid rate.
Yeah, so in this example, we were able to obtain immediate Medicaid eligibility, like Mark said, and the pre-tax status of the IRA is preserved. So after Mary passes away and the state is paid back the amount that they would have provided, the children can treat the IRA MCA as an inherited IRA, as far as not having to, we're essentially stretching out the tax consequences over a longer period of time as opposed to paying all the taxes up front. And we were able to realize a monthly savings of around $2,000. That's the difference between the private pay rate and the Medicaid rate. And we were able to provide a wealth transfer in this case of $124,250, as opposed to, if we look at the gifting plan that we talked about, we were only providing a wealth transfer of 110,000, and that amount would have been even less if we would have paid all the taxes up front. We talked about a number of around 90,000 if the taxes were paid prior to doing the gifting plan. The potential disadvantages in this case would be if Mary lives longer than we initially anticipated, then the wealth transfer is going to be reduced. It would be reduced because as Mary lives for a longer period of time, then the claim from the state is going to continue to grow because she's on Medicaid for an extended period of time. So as a general rule, life expectancy is going to be a crucial part in deciding whether we do a gift and annuity plan or if we do an IRA MCA plan, because the longer somebody is anticipated to live, it's more likely that the gift and annuity plan is going to be the best option. But if somebody has a shorter life expectancy, then it's likely going to be a better option to do the IRA MCA plan, because we're immediately getting them on Medicaid and they're experiencing a savings right away versus having to private pay during that penalty period.
So which option is better, option one or option two, or a combination? And the combination is really going to depend on the mix of assets that a client has. I think most clients are going to come to us with some IRA and some non-IRA assets, but to provide the best plan and the best advice possible, you certainly need to have the not pleasant, difficult conversation about life expectancy, and then you need to also factor for IRA assets, and to the extent they're applicable, non-qualified annuity assets. You have to factor in the income tax consequences of those assets and the deferred income that is inside of those assets, and when that deferred income should come out.
Okay, so now we're going to shift into the third option with the $200,000 IRA, and we're going to look at using a balloon style IRA MCA. The goals are going to be similar to using a level benefit IRA MCA, so I'm not going to spend a lot of time on this slide. But if we look at converting the $200,000 IRA into an income stream and also reducing the amount of income that's generated from the annuity, we could have Mary consider a balloon style IRA MCA, because the annuity does not need to pay out within her life expectancy, and it also does not need to make equal payments. So you're seeing that Mary's required minimum distribution for IRS purposes based on the $200,000 IRA value is around $13,500 per year, or $1,100 per month. By using a balloon style annuity, we're able to create around $1,200 of monthly income in months 1 through 83. And then the final payment in month 84, the balloon payment would be around $101,000. The total payout, again, is going to be slightly greater than the amount invested into the contract based on the interest that would be paid on the annuity. If we look at Mary's copay under this scenario, we're again adding her Social Security income of $1,000 per month, the balloon style MCA income at $1,224, and we determine that her total income is $2,224 each month, and then we're going to subtract out her monthly personal needs allowance at $50 to determine that she will pay $2,174 per month towards her cost of care. If we again assume that Mary passes away after 15 months, the children would have received a wealth transfer of $124,250. This actually works out to be the same number that you saw in the level benefit annuity example, and you might be asking why anybody would consider the balloon style annuity, and we're going to cover that in our next scenario where we're dealing with a much larger IRA at $500,000. So again, we're determining that the wealth transfer was $124,250 by subtracting out the MCA payments that Mary received during her 15 months while she was on Medicaid at $18,371. And then you see that the claim that the state would be entitled to is greater in this scenario because she was having a lower copay each month, so the state was picking up a larger amount. The total amount, go ahead, Mark.
Yep. Well, so that's the amount I was referring to on the previous slide, and the numbers are exactly the same. The amount that is going to need to be paid out is $75,750, but if Mary did not do the IRA MCA, if she did nothing and just spent down, then if and we don't know how long Mary's going to live, we never know that. But if she lived 15 months, her asset spend down is $7,000. Her cost of care is $8,000. Her income is $1,000. She has a monthly deficit of $7,000. The only way to make up that $7,000 is to use assets. $7,000 times 15 months is $105,000. And so there is an immediate savings by going on Medicaid immediately and doing an IRA MCA, because you're getting away from the private pay rate, and you're only going to have to pay back ultimately based on the Medicaid rate.
Okay, so now we're going to change up the scenario and assume that Mary's only asset is a $500,000 IRA account that is putting her over the asset limit.
And so real quickly, I want to, Amber and I talked about this. I want to frame this up, and people could say, how is it that someone who's got only a $500,000 IRA left? And maybe that's because Mary years ago did some pre-planning. Maybe Mary did some pre-Medicaid eligibility, pre-crisis advanced planning, where she transferred non-IRA assets to family members or to an irrevocable trust, and she did that more than 5 years ago. And so those assets are removed now. They've already been out of her name for more than 5 years, and the only asset that she kept remaining to live off of was her large IRA.
Great. So we're seeing here that the facts haven't changed as far as her monthly income is still $1,000 a month. The private pay rate is $8,000, and the Medicaid rate is $6,000 per month. And her only asset is going to be the $500,000 qualified account. If we were to go through the gift and annuity scenario, in this case, we would be making a gift of around $279,000, and we would be using 220,000 to purchase a 33-month annuity. The annuity would provide around $6,700 a month for 33 months. And since we're dealing with only IRA assets instead of the gift being the 279,000, it's going to be an amount less than that if we take into consideration the fact that taxes would need to be paid on the amount that's being transferred to her children. We did receive a question about how the gift amount is determined. In this case, we would be multiplying the penalty period that we determined of 33 months by the divestment penalty divisor in this state of $8,469. That's the average cost of 1 month in a nursing home. And each state is going to publish that number. It usually changes on an annual basis. And that's the number that determines how long a penalty period or an ineligibility period would be. So we multiply the penalty period by the divisor to determine what the gift amount would be in this example.
Right, and I'll just add to that by saying, the thing you figure out the monthly shortfall, which in our case is 7. You look at the monthly divisor that each state publishes. You add those two numbers together, and you divide it by the assets that you have remaining. Now, in our example, we did 500,000. I think Amber and I both could say we very easily could have, and this is probably the issue. This is all these things you have to factor in. So it's a good question. Is that we did 500,000 divided by 15,000 to in rough numbers. That's what we did. Now we could have if we wanted to we could have said, well, instead of using 500,000 divided by 15,000, maybe we should have said 375,000 divided by 15,000, because if we're going to gift that money out, if we're going to do a gift and annuity plan, we have to get money out of Mary's name, which means we're going to have to first take it out of her IRA, which that's going to create income for income tax purposes, and we're going to have to pay tax on that. So, we have to really factor that in, and we'd probably want to make an income tax payment because that is a legitimate spend down, and then figure out the money that we're going to have left over to calculate the term of the annuity. Either way, any way you look at this, it's a heck of a lot of tax. And so the rest of the presentation kind of shows, an alternative to that, unless you thought that Mary was going to live a very, very, very long time.
Yes. So with her making a gift, she is going to be ineligible for Medicaid for an extended period of time, 33 months in this case. And during that time frame, she is going to be paying at the private pay rate. So she would have monthly income from the annuity coming in at around $7,700 during the penalty period, and she would obtain Medicaid eligibility in month 34. And like Mark just talked about, instead of being able to gift the full 279,000, we would have to consider the tax consequences of making that gift, and the penalty period would likely be slightly less than the 33 months. However, we need to consider whether we anticipate Mary living for 33 months, because if we don't, then she's not actually going to receive any benefit from Medicaid until month 34, when Medicaid would actually start paying. If we want to obtain immediate Medicaid eligibility instead of making a gift, we could eliminate the $500,000 spend down by purchasing an IRA MCA. And you're seeing again, on this screen, we did structure the annuity over Mary's Medicaid life expectancy of 84 months. If we do that, then the monthly payout from the annuity is going to be $6,020 per month. And you're seeing, again, the total payout is slightly greater than the amount put into the annuity. When we add Mary's Social Security income at $1,000 a month and her annuity income at $6,020 per month, we see that her total income is $7,020 per month. And then we subtract out her personal needs allowance at $50 to determine that her copay would be $6,970 per month. You may recall that the Medicaid reimbursement rate was $6,000 each month. So because Mary's income is exceeding what the Medicaid reimbursement rate is, she is not actually experiencing any economic benefit. And in most states, Mary is not going to be eligible for Medicaid because her income is exceeding what the reimbursement rate would be at that facility. So instead, we looked at using a balloon style IRA MCA to reduce the amount of income that's coming out of the annuity contract. And we structured this again over 84 months and determined that her required minimum distribution was $2,800 per month based on the $500,000 IRA value. The balloon style annuity would make payments of around $2,800 in months 1 through 83. And then in month 84, the balloon payment of $268,000 would be made, so that the total payout is around $508,000. If we add the annuity income at $2,880 per month and add the Social Security income at $1,000, we determine that our total income is $3,880 per month. And then we're subtracting out the personal needs allowance at $50 to determine that her copay is going to be $3,830 each month. If we assume that Mary passes away after 15 months of being on Medicaid and Mary's children are listed as the remainder beneficiaries, her children would receive a wealth transfer of $424,250. And we worked out the math exactly the same way as the last example, where we're subtracting out the MCA payments that she received during the 15-month time frame at $43,000 and subtracting out the amount that the state would have been entitled to as the primary beneficiary to determine that the total amount of assets that were spent during the 15-month period was $75,750.
And it's always that same number of $75,750. That's the advantage of being able to pay at the Medicaid rate, the Medicaid reimbursement rate, rather than the private pay rate.
Yes. The advantages in this case are going to be similar to the last one, where we're obtaining immediate Medicaid eligibility, we're obtaining the Medicaid reimbursement rate, and the wealth transfer is $424,250. If we assume that Mary passes away after 36 months of being on Medicaid and she did the IRA MCA with the balloon payment, then in this example, the children would have received $318,200 as the remainder beneficiary after the state is repaid for the amount that they would have provided during the 3-year time frame. So if Mary would have privately paid for 36 months as opposed to obtaining Medicaid eligibility for the 3-year period, she would have paid $252,000 out of pocket. We determined that by taking the shortfall of $7,000 per month and multiplying that by the 36-month period. But by proceeding with the balloon style IRA MCA, she was able to provide a wealth transfer of $318,200. I'm going to turn it over to you, Mark.
All right. So as we were putting this presentation together, and we know we're running out of time, it occurred to us to say, well, if you have the payment amount too much, you may not get any value for doing the IRA MCA. So, what we did is we went through the mechanics of figuring out, well, if you're going to do a IRA MCA to take advantage of the lower Medicaid reimbursement rate, and that's if you're going to do a plan like this, you have to find out what that is. You're going to have to somehow do some digging and do some investigating and find out what that is in your case. But once you know that, then you can calculate the maximum amount that you want the IRA MCA to pay out every month. And then so that in this case, we want to take the advantage of the $2,000 difference. So we don't want the payout to be too much, because otherwise you're not going to get the value of that $2,000 difference dollar for dollar. And that's the goal. So what you do is you figure out what the Medicaid reimbursement rate is, and you subtract the monthly income. In our example, that's $6,000 minus $1,000 equals 5. Step 2 is you figure out what the private pay rate is minus the Medicaid rate. That's $8,000 minus $6,000. That's the $2,000 difference. And then what you do is you take the result from step 1, which is 5,000, minus the result from step 2, which is 2,000, and that gives us a number of 3,000. So in a case like this, the maximum reimbursement that we would want, or the maximum monthly amount on that IRA MCA, we would want it to be $3,000 or less. To have it more than that would not be providing as much economic benefit to the family as we could be providing. So this slide just shows the mechanics of that. We know what the private pay rate is. We know what the income is. The monthly shortfall or deficit is $7,000. If Mary lived 36 months, she'd pay out $252,000. If you follow the previous slide, the steps from the previous slide, we know that the maximum payment amount on the IRA MCA should be $3,000 per month. So if we pay $3,000 per month and Mary lives 36 months, we're paying out $108. The amount that's going to have to be paid at death because the state has to be named as the beneficiary is going to be $2,000, and we know it's $2,000 because Medicaid's going to pay the facility $6,000. It's received $1,000 of income from Mary, that's her Social Security income, and it's received $3,000. Mary's paid $3,000. So what Medicaid has really had to pay out in that case is $2,000 per month to the facility, because Mary's paying $4,000. And so 2,000 times 36 is 72. So the amount that you pay under the IRA MCA approach, the amount that would be expended, would be $180,000, which is $72,000 less than if she would private pay and did nothing. So when dealing with IRAs, you're always going to want to think about the income tax consequences, and you always are going to want to think about the client's life expectancy to help you decide what's going to be your best planning option regarding Medicaid.
Okay, and it does look like we are out of time. We do have a couple of questions. One is asking if somebody wishes to stay in their home, is there any way that they can, is there any long-term care benefit from Medicaid? Mark, did you want to take that?
Well, it all depends on what your state allows. The traditional Medicaid is for nursing homes. A state can apply to the federal government to have expanded Medicaid. It's called to get a waiver for the program, and these are called home and community-based waiver programs. And how robust each state's program is depends on the state. So it all depends whether it's going to be economically worthwhile or not. For example, practicing in the states of Kansas and Missouri, the benefit there for home care services is not all that great, and in Wisconsin, it's better.
Perfect. Okay, well, there are a couple other questions that I'll reach out to each person that asked the question directly because we are out of time, but I want to thank everybody for joining us today. And I thank you, Mark, for presenting with me. And I hope everybody on the webinar has a happy holiday season. And we look forward to other webinars in 2020.
Thank you, Amber. I appreciate the opportunity to work with you.
Thank you.
Bye-bye.